And for further analysis, we are joined from Warsaw by Mr. Khalid Al-Khatib, the Chief Market Analyst at Easy Markets. Welcome, sir, to Q News, and thank you for joining us here today. And let me start off and ask you, just how serious is the economic fallout from the Iran war becoming for the global companies?
Good morning, and thank you for hosting me. Well, to start with, it is a really big risk what we are facing right now. The issue is not that only the Strait of Hormuz is closed and the oil prices are high. The issue is that the war is still ongoing, even there is no further escalation, but the closure of the Strait of Hormuz is having a huge impact on oil prices, which is, of course, affecting the profitability and the expenses on these companies. And I believe the higher risk will show in the markets and in the economic numbers whenever these higher expenses or the inflation is transferred from the producer to the consumer side. And last week we saw the PPI numbers high, the CPI numbers high, and transferring this cost from the producer to the consumer, of course, will affect the profitability of these companies and the demand as well.
Yes. Mr. Khalid, we've been hearing businesses have already lost more than $25 billion. Do you think that figure could rise dramatically if the conflict continues?
Of course, this figure will rise dramatically if the conflict will continue. The higher risk right now is that the countries are using their oil reserve, and with time, the oil reserve is getting lower and oil prices are expecting higher. In addition to that, we know that the prices we are seeing on the screens for oil is different from the physical oil that's being delivered to the countries. So all these higher expenses are putting additional pressure on the balance sheets of these companies. And with time, it will be affecting the demand as well, which will have additional impact, weighing heavily on the profitability.
Yeah. And how much is all of this crisis coming down on the Strait of Hormuz and the rising oil prices?
Well, the rising oil prices will be affecting everything. It's not about the oil prices as well. It will be delivered to the food products, to the transportation, to anything. And this, as well, as I mentioned, it was reflected. One of the reports we saw last week, the PPI and the CPI, which is expected to see this in the future as well. Also talking about the market pricing, pre-war we were expecting 2 to 3 rate cuts during 2026, speaking about the Feds. Right now we are seeing no rate cuts, but on the other hand, we are hearing about rate hikes in order to fight inflation. The biggest risk is not only inflation going up, but the growth going down. And here we are talking about the stagflation scenario, which is the worst scenario any central bank would face.
Airlines are reporting massive fuel cost increases. Do you think the consumers are about to see even more higher travel prices than they actually are at the moment?
Unfortunately, the airlines are, of course, that's normal. They are transferring these higher costs to the consumers. That's why we are seeing higher ticket prices. The rerouting of the flights in order to avoid the regional interruptions as well is playing a major role, and we are seeing higher ticket prices. In addition to that, we are reading that a lot of flights are being cancelled due to the lower profitability we are having. So this is expected to continue, especially as long as the war is going on, or at least the closure Strait of Hormuz is going on.
Mr. Khalid, do you think this conflict could push inflation higher again around the world?
Of course, it could push inflation higher in the world. And the major risk is that, let's say right now, there's a deal between the US and Iran, and the Strait of Hormuz is open. In order for the logistics and ships to be delivering oil again, it needs a couple of weeks. Plus, in order for the oil refineries that were damaged during the war, it needs several months in order to be back to production. And during all this time, the countries that used huge amounts of their reserves will be demanding additional oil. So all these factors combined together will be putting additional pressure on oil prices, and we are not expected to see lower oil prices even if the conflict is over. That's why inflation is expected to stay high in the near future.
And do you think ordinary consumers already are changing their spending habits because of the rising fuel and energy costs? What do you think?
I believe, yes, it's a normal reaction from the consumer due to the situation, and it's a normal reaction whenever the consumer is seeing the higher prices. They are spending less, and here we are back to our point that we mentioned, that whenever we are seeing the higher prices, which is higher inflation, plus the less consumer spending, and as we all know, the consumer is one of the main assets in the economy, especially in the US. Here we are talking about the stagflation with the lower growth and higher inflation prices.
And why are the European and Asian companies being hit particularly hard? Can you explain to us, sir?
Sure. In general, Asia and Europe are heavily depending on the Strait of Hormuz and the transferring of the oil and gas. That's why the interruption that we are seeing in Strait of Hormuz is putting additional pressure on Asian companies or Asian countries in general. They are facing shortage in oil or really high prices, which is being reflected on the companies. And as for Europe as well, they are facing this a huge issue. They were previously having the problem with the Ukraine and Russian war. Right now, this added an additional catalyst regarding the gas and oil prices. And we know that during this period, the European countries will be like filling up the reserve for the upcoming winter. So this is causing additional problems for the European countries.
Yeah. We're seeing companies cut forecasts and suspending dividends. Do you think corporate confidence is collapsing?
Collapsing, I believe, a little bit a big word, but we are saying that the confidence is dropping right now, especially with all the uncertainty we are seeing in the markets. Even that we are having sometimes some optimistic headlines, specifically from the US president regarding the war, but currently it's not holding as much weight as used previously, due to several reasons, the inside trading, or several times they are mentioning optimistic headlines than Iran is rejecting. That's why we can see that the huge amount of uncertainty these companies are having is increasing with time as the war is going on.
Yeah. And how vulnerable are the global supply chains right now compared to during the COVID-19 pandemic?
Well, I believe it could be more vulnerable than during the COVID-19. The COVID-19, the impact took place. The central banks like took their step in order to boost the economy, and things started to work on with time. Right now, we're almost like 2.5 months after the war. We're still having all the uncertainty. The supply chain is not being resolved. The main issues between Iran and the US is not being resolved in terms of who will control the Strait of Hormuz regarding the nuclear program. So all these questions that we do not have an answer is affecting the whole supply chain and the whole economies as well.
Absolutely. But do you think this could become a turning point for the global economy if the war drags on?
It could weigh heavily on the global economy, and maybe to be more specific, it could have a strong impact on the technology stocks. But I believe the stocks or equities, generally speaking, specifically about the AI and technology, they are not reflecting the real impact of the war. What is more reflecting the impact of the war currently, we are seeing a huge move in the treasury yields across all the world. So continuing this war and all the uncertainty, we will see higher yields, higher inflation expectations, the central bank trying to fight inflation and at the same time maintain growth, which is known as a dual mandate. And with time, I believe this will have huge impact.
And Mr. Khalid, could you maybe tell us which industries do you think should be the most worried over the next few months?
The industries that are the most worried, of course, it will be the airline industries. They are the most affected. They should be really worried. Regarding the tech and AI, I'm not going to say worried, but should be very cautious, especially if any investor want to invest in these companies specifically. Yes, we are seeing higher highs, some optimistic news. These stocks and equities are just taking the optimistic headlines and moving based on this. But on the other hand, they are ignoring or disregarding all the risk that we are having from the war, which we mentioned previously regarding the higher cost, the higher inflation, what is the profitability versus the investments they are making. So I believe this industry is a little bit risky at the moment, at least for me.
Yeah. And are companies able to pass these higher costs onto customers, do you think, or will the profits just take the hit?
I believe at some point these companies will pass these higher costs and expenses to the consumers. They will not absorb it. And here, which will be the higher risk, which we said that the consumer spending or the demand will drop. And at the same time, we are seeing higher inflation and higher oil prices. And here the central bank's dilemma between, which is the stagflation, between trying to control the inflation or at the same time stimulating growth, which I believe the central banks will go into fighting the inflation more.
And investors still seem relatively calm. Are markets underestimating the economic danger, do you think?
I believe, yes, some markets are underestimating the economic dangers and the economic situations. As we said it, that the higher highs or the historical highs we are seeing on the US equities, and at the same time, the issue in the Middle East is not resolved. Strait of Hormuz is still closed. So the markets are just taking the optimistic headlines. They are looking at the company earnings or any headline regarding that we will see a deal that will take place in the Middle East. But we mentioned that even if a deal takes place in the Middle East, it is not like things will be resolved immediately. Everything needs time, and from oil prices back to pre-war. So I believe it is ignoring what is going on to some point.
And what signs should people watch out for to actually understand whether the economic situation is getting worse or better?
I believe what is currently reflecting the real economic situation and what is going on are the yields worldwide. You can look, investors could look at the 2-year treasury yields, of course, to assess what could be the next step for the central banks. The 10-year, the 30 years, of course, for the longer term vision. So I believe that the yields are reflecting more what is going on more than the equities in general or stocks.
And if the conflict escalates further, what's the worst case scenario, do you think, for the global economy, if you can tell us?
If the conflict escalates further, or if the conflict prolonged and not being solved, I believe, of course, oil prices is the highest risk. Reaching higher oil prices, maybe to the 140, 150, will put additional pressure on the companies or on the general economy in general. Higher inflation, less demand, and here it will be the problem for the central banks in order to fight this inflation.
And how much do you think of the current economic anxiety is being driven by uncertainty rather than the actual physical disruption?
I think both are like parallel together. You know, regarding the uncertainty, as we said, the U.S. equities or the equities in general, they are not taking it too much into consideration. They are just looking for any optimistic headline they read regarding a deal being reached. They are not taking into consideration that the real disruption that it's taking place, and if this issue is resolved, how much time the shipping and the logistics need in order to get back to normal. So I think it's like they are in parallel.
Do you think we're beginning to see maybe panic planning inside the major multinational companies?
I believe, yes, the multinational companies are more aware of what is taking place in the economy. The retail investors are not really aware. They are just waiting for any buying the dip. They are waiting for any price drop in the equities in general, or specifically if we are talking about the AI and technology. But for giving a small example, due to the disruptions and the issues that took place in Qatar, the helium supply is being disrupted, and we know that helium is heavily used in chips and the AI. This is one small example which individual investors are not taking into consideration. And here, I believe the fear that we could see some kind of correction on the equities in general, especially due to these examples that I gave, and due to the higher yields that we are currently experiencing.
And how exposed are the developing economies to another major oil shock?
It is really exposed, of course, because they are heavily related. They really need oil in order to continue production and continue boosting their economy. And we are seeing a huge amount of disruptions currently. We mentioned it, so that's why they are having a higher risk than other countries. Of course, the U.S. currently is not facing oil shortage because it is one of the biggest oil producers, but the impact on the US, for example, is due to the higher oil prices, which is affecting the inflation, and we saw the numbers last year. So it is different between each country. Either you are an oil producer or you are importing oil in order to just make the normal production in your country.